my attention. Why did it get my attention, guys? Well, volume and price, Stuart says, but what else might have got my attention, Stuart? Yep. Somebody actually came in real time and bought $200,000 premium call options with a big strike price and a short duration. Somebody bought 200 grand's worth of premiums right there. Now, one of the things that you'll start to remember is that when I tell you that somebody's buying calls, it doesn't mean feck all at that stage, guys. Just because I tell you that they're buying calls, that's not an end position. It's a beginning position, right? It's a beginning position. Because now what you've got to do is you've now got to try and paint, you've now got to go backwards at that stage and paint out the picture. So remember, at this stage, I don't know anything about this stock. It's not on my radar. It's not came up any of my ideas. It's not got anything. And then suddenly somebody comes in and aggressively pays $200,000 premium for quite significant OTM, short duration, sweep order. This was a question that Cliff had asked earlier. Short duration, sweep order, OTM, sweep order, and when I say aggressive, of course, what I'm talking about is they're crossing the spreads. They're not sitting on the bid waiting for price. They're crossing the spread. And somebody came in and did 600 grand of calls, 200 grand of calls. Now that's the first time it catches my attention. That's the first time it catches my attention at that stage. Now, what happens next? What happens next at that point? Well, at that stage, of course, that's when it starts asking me questions. This is the starting point, remember, guys. This isn't the finishing point. So what happens next is I then look at this stock. This now gets my attention. It might not mean anything. I'll maybe tweet it out. But at this stage, I've not done any analysis on it. I've not came up with any particular conclusions about it. So what I'm going to have to now do is try and figure this out. So what I'm looking for now is this. What I'm now looking for is the history. I now have to try and recreate the narrative at this stage, right? I've got to go into the background of this stock and try and figure out what that call option means, if anything, perhaps. If anything at all, what does it mean? What was the strikeout of the money? 20s, Andy, 20s. And they were giving themselves 2 weeks. So they were buying 20 calls at the 20 strike OTM calls. So it's only a $15 share, right? So that's a very, very big 30% rise in the stock price. So I've got to recreate the narrative, and the narrative that's recreated is one, a prior increase in short interest. Two, a gap up trapping the short interest in a negative position. Three, and then four, of course, we've already seen the so we look back round to the call option at this stage, Andy, right? So when we look back round to the call option, what do we then see? So this call option comes in just here. The first call option comes in just here. What do you see next? What do you see next, guys? Something very, very, very important. Volume's one of them. What else is what's the other one? What's the other one? The fact that the price moves away from that call option price quite easily. In other words, this is now starting to develop round. 5. Stock volumes appear on the uptick. Yeah. 6. The price accelerates away from the options trade, which obviously suggests what? Dealers are hedging and not accepting. Dealers are hedging that position and not accepting. 7. Dealers hedge means buying at higher prices and therefore no sellers. Okay? So what happens next to this stock? Well, let's take a look, guys. Let's take a look at how this story unfolds. We crash into the $15 level. Now, we know that $15 should expect to see the price pushing back against this trade, right? And then what happens? The price pins the top edge on high volumes, just as we go through the top edge again, as we pull back into the same kind of top edge we've seen before, and the price is defended at higher prices. Maybe the market maker who hedged in here started to defend the higher prices. Remember, the market maker's got the ability to start selling some of those shares if they feel that the stock is perhaps starting to rotate. So obviously one of the things I could then look at is I could look at the S&P and I could start asking the question, well, maybe because the index is getting smashed up, they might start selling it. But the index, unfortunately, wasn't getting smashed up at that stage. The index had actually just taken a new lift at that point. So obviously there may well have been some profit taking by the dealers in here, hence the reason why there's a big pin and there's a big spike in volume. But what happened next, guys? What do you think happened next? There was a huge increase in volume as the stock broke through that key level just there. Another huge increase in volume, and the stock looks as if they've hedged out their position here. The prices dropped down. The equity index continued to rise. The equity index continued to rise. And the dealers suddenly thought to themselves, my God, I'm going to have to buy those bloody those shares straight back in, right? 8. Watch the underlying index. Because that brings a need to hedge, doesn't it? Brings a need to hedge into that storyline. And what happens next, guys? What happens next? Well, interestingly enough, see this arrow? $15.20. Somebody came in and bought $200,000 worth of options. Right there. So somebody bought 200 grand worth of options there. Somebody then doubled up on their position there for 200 grand. And look at the volume that follows in behind the stock again. Do you see it? Look at the volume that follows in behind the stock right there. Look at this huge increase in volume and the fact that the price takes off almost immediately. And what happens next? Somebody came in for $200,000 worth of options here. Somebody came in for another $200,000 of options right there. We're now at $600,000 worth of options getting traded. And what happened next? The price came back to these levels. Massive stock buying came in. Possibly dealers buying the stock at that price there. Possibly dealer buying coming in there. What happened next? What happened next, guys? Somebody came in for $200,000 of options. I'm saying 200,000. It might have been like 100 grand or whatever, but it was always a three-figure option sum. It was like an average of coming out at about maybe around about 150 or thereabouts over all these options. I can't remember each one of them individually, but there was a consistent. So that was a call option buy. This 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 was a call option buy. And then eventually we got up to $18. Call option buyers, call option buyers, call option buyers, call option buyers, call option buyers. Total trade probably just under $1 million, all with the $20 strike. $1 million, guys. And it all started way back at 15s. Now, if you'd recognized the trade at 15s, now to try and give you some sort of context to this, if you'd recognized the original trade at 15, then obviously that's a $3 profit on a $15 stock. You've just made a very, very nice profit of 20% on your stock position, right? 20%. If you'd bought the option at the same time, you made 100%. Gene trades the options markets. So if you'd bought the option, the same option, you would have, it went from like 50 cents to buy that option to $1 to, well, $1. The last trade here was for $1, by the way. That trade there, that cost them, those guys, 95 odd cents. So it was costing 50 cents here. This trade here, that option cost them 50 cents. This option here cost them 90 cents. If I remember the numbers right, it was about 95 cents or something like that. So obviously by the time you got up to the top edge here, it was probably going to be what, about $1.20 or something like that, $1.20. So obviously if you'd bought that same option, say you paid 55 cents for it, and it got up to $1.20, then obviously you've made over 100% return on your money on that day, on the money that you've invested on that trade, right? And that's where the trade sticks. Obviously coming into the closing bell, of course, you get this correction into the close itself, and it's that's the end of that trade, perhaps. Obviously this morning will reveal potentially otherwise, but that's certainly the end of that closing trade. But I hope that's of interest. I hope that's something that you can start to understand a little bit about, because this isn't just about that stock itself. This is about the fact of the stickies and the slippies, which are now in focus for a lot of people these days. Everybody trying to figure out what stickies and slippies mean. Everybody trying to figure out what stickies and slippies are talking about. And obviously the idea of stickies and slippies becomes the main talking point for everybody. And obviously that's going to be something that we're going to be paying attention to when we're looking at these things, yeah? Interesting? Well, I think it is, but whether you think it is or not doesn't really matter. It still might be interesting to some of you. It might be something you quite fancy doing in the future, is trading stocks. I know Cliff's got specifically an interest in this. So it's maybe something that you guys like to think about possibly as an addition to some of your other trade ideas, and taking that type of trade forward. You only need to find that one stock every day to make 20 to 100%, depending upon whether you're trading options or whether you're trading stock positions. If you make 20% a day, guys, my God, you're in great shape, right? Every week you're doubling your account. Every week you're doubling your account. It's not going to take you too many weeks to get your account to that $1 million trader level, if you can double your account every week. But that's the challenge, of course, whether this sets up once a week, whether it sets up 2 or 3 times a week. It's, you're not going to get these types of trades every day, I don't think. you know, you're going to have to really do a lot of digging to find those types of trades. But, you know, we'll have a look again today, and if I can see any happening in real time, I'll tweet them. I don't want to, you know, want to show you stuff in hindsight, but it's in hindsight to learn about it. And then on the right-hand edge, perhaps to start maybe looking at them. All good? Damn tootin' right it is. Anyway, I gave the bond traders this morning a trade at 16s. Did anybody decide to join me on the long bond at 16s? Anyone decide to join me on the long bond at 16s? NFP. It was a bold trade. We obviously suggested the 16s earlier on to the guys in the room. If you're wondering what we're talking about, 16s. We suggested 16s earlier on to everybody. And the 16s have stuck beautifully, and we came into the 16s, big surge of volume, of course, and we've just went from 16s up to 16s, so it's $1,000 very quickly. Laurie, how can you do this and stay within your 2% risk? Well, there's a couple of things. Are you talking about that options trade? Are you talking about that stock trade that we've just went through there, Laurie? Well, there's two ways. Number one, you increase your risk from 2% to say 5%, because you're adding a probability to that, which makes it a very high probability. So you may well want to increase it up to about 5%. But when you're talking about 2% risk, I mean, if you've got an account, say, of you know, $10,000 or $100,000, then it just means that you buy call options for $2,000 or for $200, right? You just buy as many call options as you can for your 2% risk. And that way, if you wipe out all your calls completely and they're worth nothing, and the chances of that happening are quite slim, right? Then you lose 2%. You can't lose any more than 2%. You probably won't even lose 2%. You'll probably lose a little bit less. That's why I'm saying in an options trade, Laurie, you could probably go in risking 5% of your account. Because even if your option dropped by half, you're still only losing 2%, 2.5% of your account at that stage, but you buy 5% of options. Now, obviously, if you buy 5% of your account in options, in that case, you've just made a 5% gain on your account. Now, that's obviously a good gain for a scalp in the options markets. But when you think about it, why wouldn't you take the stock position then? Because obviously, if I take an outright stock position at $15, a 10% move against me would take me down, a 10% move against me in the stock position would take me down to $13.50. So obviously, if I said, right, well, what about $14 then? What about a stop at $14 as an outright position? You could effectively risk 100% of your account on that trade, couldn't you? You could risk 100% of your account on that trade. So what would happen is if you saw this as an outright stock position, you could say, well, you know what, I'm going to put a stop in at $14, hard stop. If it goes there, then I've got it wrong anyway, right? I'm risking $1 on a $15 stock. So, you know, fair enough. It's risky, but yeah, it's doable. You know, we can live with that type of risk. It's not maybe as tight as I'd like, but obviously you could also do a $14.50 risk. If you're buying in at this trade here, for example, you could put your stops in at $14.50 or even the break back below the $15. Your risk is going to come shooting down at that stage in percentage terms. And once it starts to make its move, the ability to just ramp that stop up to $15 again and just sit behind those call options is a very, very good trade. Yeah, makes sense.